When people picture Canada's economy, they usually imagine something calm and fair-minded. A country of open spaces, polite institutions, steady growth, and sensible regulation. It feels like the opposite of cutthroat capitalism. And for a long time, that image made sense. Canada's economic story grew out of scarcity, distance, and survival. Small populations spread across vast land needed coordination more than chaos. Stability mattered, reliability mattered, scale mattered, and out of those incentives, something very specific began to form. Because here's the quiet truth that rarely makes it into everyday conversation. Canada did not build its economy around fierce competition in every sector. In several critical areas, it built something closer to protected dominance. Not always by accident, not always by force, often by design. If you go back far enough, you can see why. In the early days, Canada faced a problem that many young countries do. Infrastructure is expensive, markets are thin, and duplication is inefficient. Building parallel railways, parallel power grids, or parallel national networks in a sparsely populated country doesn't just waste money, it threatens collapse. So policymakers, investors, and businesses made a trade. Fewer players, larger scale, and in return, promises of stability, national coverage, and long-term investment. At first, this looked less like monopoly and more like coordination. One firm could take on risks that 10 smaller ones couldn't. One network could reach places competition never would. One dominant institution could survive downturns that would wipe out fragmented rivals. And in a young economy trying to stand on its own, that mattered. But incentives have long memories. Once dominance is established, it changes behavior. Protection reshapes priorities. When a firm knows its position is secure, the pressure to innovate weakens. Prices become less sensitive. Customer experience becomes secondary. Profits become predictable, and predictability invites influence. Over time, rules meant to protect the public can quietly begin to protect the incumbent instead. This isn't unique to Canada. Economists have debated this tension for centuries. Scale brings efficiency. Competition brings discipline. Too much of one weakens the other. The interesting question isn't whether monopolies exist, but how they come to feel normal. And in Canada, they really do feel normal. Think about the services people rely on every day. Banking, telecommunications, transportation, food supply, energy. These aren't luxuries. They are economic arteries. When a small group of firms dominates these spaces, their decisions ripple outward into prices, wages, innovation, and even national identity. A fee increase isn't just a corporate move, it's a household adjustment. A policy change isn't just internal, it becomes national. What makes Canada's case especially fascinating is that many of these dominant players aren't hidden villains. They are trusted institutions. Some are decades old. Some helped unify the country. Some weathered crises and kept the system running when others failed. Critics argue they limit choice and raise costs. Defenders argue they provide stability in a country where fragmentation would be dangerous. Historians still debate whether the trade-off was worth it. That debate matters because once protection is embedded, it's hard to unwind. Barriers to entry don't just keep out competitors, they shape the future. New ideas struggle to scale. Foreign challengers hit regulatory walls. Consumers adapt their expectations downward. Over time, people stop asking why things cost what they do and start assuming that's just how it works. And this is where the story starts to get interesting. Because Canada didn't end up with just one protected giant. It ended up with a handful, each operating in a different corner of the economy, each reinforced by history, geography, and policy. Together, they form a quiet architecture of control. Not absolute, not unchallenged, but persistent. Understanding how this happened isn't about outrage or blame. It's about incentives. It's about asking what problems these structures were originally meant to solve and whether they still solve them today. It's about recognizing that economic systems don't freeze in time. They drift. They accumulate power. They inherit assumptions. So as we move forward, keep one thought in mind. If you design an economy for stability long enough, you may eventually have to ask whether stability has turned into stagnation. And if you design protections to help a nation grow, you may one day have to decide who those protections are really serving now. That's the story we're about to walk into. At the center of Canada's financial system sits a small circle of banks that grew up alongside the country itself. In the late 19th and early 20th centuries, Canada made a deliberate choice to favor large, well-capitalized banks that could survive panics, fund railways, and move money across enormous distances. That's how institutions like Royal Bank of Canada, Toronto-Dominion Bank, Bank of Montreal, Scotiabank, and Canadian Imperial Bank of Commerce came to dominate. The incentive was simple. Fewer banks meant fewer collapses. And in fairness, this system did exactly what it was designed to do. While banks failed across the United States during the Great Depression, Canada's major banks survived intact. That success hardened the structure in place. Over time, safety turned into insulation. Competition became cautious. New entrants faced steep regulatory and capital barriers. Today, the same stability that protects savings also keeps fees high and innovation slow. Is it a price worth paying? Economists still argue about that. Move one layer outward and you hit communication, another sector shaped by geography and early policy. Canada's size made nationwide networks incredibly expensive to build. So instead of encouraging many overlapping systems, regulators favored a few giants that could afford the infrastructure. That's how companies like Bell Canada, Rogers Communications, and TELUS became the backbone of phone, internet, and wireless service. The logic made sense at first. Who else would run cables to remote towns or maintain service across frozen terrain? But once the networks were built, control followed. Prices stayed high by international standards. Smaller competitors struggled to scale. Customers learned to expect contracts, overage fees, and limited choice. The technology kept advancing, but the market structure barely moved. It's efficient, yes, but it's also remarkably comfortable for those at the top. Transportation tells a similar story, especially when you look at railways. In the 19th century, rail wasn't just a business. It was a nation-building project. Linking coasts was a political and economic priority, and only massive, well-protected companies could take on the risk. That's how Canadian National Railway and Canadian Pacific Kansas City came to dominate freight rail. Duplication would have been absurd. Two parallel tracks across thousands of kilometers would bankrupt anyone foolish enough to try. So the country accepted concentration in exchange for connectivity. Today, those same railways move grain, oil, minerals, and manufactured goods with incredible efficiency. But they also set terms. When bottlenecks happen, farmers and exporters feel it immediately. The system works, but it works on the railway schedule. Then there's food, the most everyday monopoly of all. Canada's grocery sector didn't start out concentrated. Small chains and local stores once thrived. But over decades, scale won. Distribution networks, supplier bargaining power, and real estate access favored the biggest players. That's how companies like Loblaw Companies, Empire Company, and Metro Incorporated came to control most shelves. This concentration lowered logistics costs and standardized supply, which helped keep stores stocked across the country. But it also narrowed competition. When food prices rise, consumers often feel trapped. Switching stores doesn't always change outcomes because the same few corporations sit upstream. Is this price behavior collusion or coincidence? Regulators and scholars debate it. What's clear is that bargaining power flows upward, not downward. Energy adds another twist, because in many provinces, the dominant player isn't private at all. Companies like Hydro-Quebec were created to ensure reliable, affordable power and keep profits within the public sphere. The incentive here was sovereignty and control. Electricity is too important to leave entirely to market swings. These entities succeeded in building massive infrastructure and delivering relatively low-cost power. But monopoly, even public monopoly, shapes behavior. Innovation moves at a bureaucratic pace. Consumers have no alternative provider. The trade-off is stability over choice, a recurring theme in Canada's economic design. A quick look at air travel shows how these patterns repeat. After waves of consolidation, most domestic flights now revolve around Air Canada and WestJet. Canada's population density makes sustaining many airlines difficult, so regulators historically accepted concentration to maintain nationwide service. The result is predictable routes and reliable coverage, but also higher fares and fewer options than travelers often expect. To see how all of this connects, imagine a normal household. They get paid through a major bank. Their paycheck clears safely, but monthly fees quietly accumulate. They pay for internet and mobile service from one of few providers, choosing between plans that look different but cost about the same. Their groceries come from a store that shares suppliers with its competitors. Electricity arrives from a single provider with no alternative. When they ship goods or travel long distances, the same limited networks move everything. None of this feels dramatic. It feels routine. And that's the point. Monopolies that endure don't feel like monopolies. They feel like the default. What makes Canada's situation unique isn't corruption or conspiracy. It's continuity. Each dominant position emerged to solve a real problem. Sparse population, harsh geography, fragile early markets. Over time, solutions became structures, and structures became habits. The debate today isn't whether these firms should exist. It's whether the balance between protection and pressure still makes sense in a world where technology lowers costs and alternatives are more plausible than they once were. And here's the subtle part. Protected markets shape expectations. When consumers don't expect choice, they stop demanding it. When firms don't fear entry, they plan differently. Economies don't just run on laws and capital, they run on assumptions. So when people ask why Canada feels expensive or why innovation sometimes arrives slowly, the answer isn't a single villain. It's a system optimized for safety that may now be wrestling with its own success. So here we are at the end of the road, and I want to zoom out for a second and look at the shape of what we just walked through. Canada didn't wake up one morning and decide, let's make everything expensive and mildly annoying. The system we're talking about grew out of very old incentives. A huge country, a small population, harsh logistics, massive infrastructure costs, fragile early markets. When you're trying to stitch together a nation across thousands of kilometers, you don't always get the luxury of 10 competing railways, 12 competing national phone networks, and 50 competing banks all fighting it out like a reality show. You get one or two big players, and you hope they're strong enough to carry the load. And for a long time, that bargain delivered what it promised. Coverage, coordination, resilience. It's not nothing that Canada built a reputation for institutional stability. It's not nothing that its banking system didn't implode the way others did during historical shocks. It's not nothing that remote communities can still get connected at all. Those are real achievements, and they came from deliberate choices. But here's the part that always sneaks up on successful systems. The better they work at first, the harder they are to question later. Because once a market becomes protected, protection starts to behave like gravity. It pulls power into fewer hands. It turns customers into captives, not because anyone is evil, but because the structure makes it rational. If you're a dominant firm, why race to innovate when the customer has limited escape routes? Why slash prices when you don't have to? Why move fast when moving slowly still pays? And if you're a consumer, what do? You adapt. You shop around, but the round part is smaller than it looks. You switch carriers, but it feels like switching seats on the same plane. You try a different grocery store, and the bill still gives you that little moment of silence at checkout. You negotiate bank fees, but the baseline fees don't disappear, they just change clothes. You don't feel like you're being attacked. You feel managed. That's what makes this story so slippery. It's not a dramatic villain story. It's a system story. It's also a story about trade-offs that people genuinely disagree on, and that matters. Some economists will say concentrated markets are the price of doing business in a country like Canada, and that the stability is worth it. Others argue the country has gone too far, and that protection has become less about national coverage and more about comfortable incumbency. There are smart, evidence-minded people on both sides of that debate. But even if you disagree on the diagnosis, you can still recognize the feeling of the symptoms. The feeling is, why does it cost so much for things that should be simpler by now? In a world where technology makes distribution easier, where digital banking can scale quickly, where communication can run on software as much as hardware, where logistics are optimized by data, why do the big everyday essentials still feel like they're priced for a different era? Why does progress feel like it arrives with a premium attached? And now we get to the part where I'm going to drop a line that will make some people nod and others immediately want to throw their phone onto a pillow. Here it is. Canada isn't really a free market economy in the places that matter most to your daily life. It's a subscription economy run by a small club, and most of us are paying membership dues without realizing we ever joined. That's the spicy take. Not because Canada is secretly sinister, but because the practical reality of your household budget is shaped by a handful of gatekeepers. When a few institutions dominate finance, communication, transportation, and food, it means the basic cost of modern life is negotiated upstream, out of sight. The market still exists, but it doesn't always feel like a marketplace. It feels like a toll road. You can choose which lane you're in, but you're still paying the toll. And once you see that, the stakes rise a little. Because this isn't just about your phone bill or your grocery bill, annoying as those are. It's about what kind of economy you're living in without having to say it out loud. An economy with more competition tends to reward speed, experimentation, and customer experience. It can also create instability and chaos. An economy with more protection tends to reward scale, predictability, and durable profits. It can also create stagnation and high costs. Neither is purely good or purely bad. The question is where you put the dial and whether the dial has drifted over time. And drift is the key word. A lot of systems don't become unbalanced through one big decision. They become unbalanced through accumulation. One merger that seems harmless. One regulatory choice meant to be temporary. One policy written to solve last decade's problem. One more barrier to entry justified as consumer protection. One more rule that sounds neutral but happens to fit the incumbent's business model like a glove. Then a generation grows up inside that arrangement, and it stops feeling like a choice at all. It starts feeling like the weather. It's just there. So if you take anything from this video, let it be this. When you hear the word monopoly, don't picture a cartoon tycoon with a top hat. Picture a system where the easiest path is to keep things the same, because the people who can change it are the people who benefit from it staying the same. Now, to be fair, Canada has pushed back on this in different ways at different times. Regulators debate competition policy. New entrants try to break in. People demand more transparency. Sometimes changes happen. Sometimes they don't. And part of the reason they don't is because the original logic still has teeth. Building national-scale systems is genuinely expensive, and sustaining many competitors in a thin market is genuinely hard. But hard isn't the same as impossible. And this is how it's always been isn't the same as this is how it has to be. So I want to turn this back to you, because this topic only really comes alive when it touches real life. Where have you felt the small club affect the most? Was it telecom, banking fees, grocery prices, air travel, shipping, rent, and housing services that seem to move in lockstep? Or did you actually have an experience where a dominant system worked brilliantly for you and you felt grateful it existed? Drop your stories in the comments. Keep it specific. What changed? What surprised you? What felt unfair or what felt stable in a good way? And yes, I'm actually going to be in there reading them. If you share your experience, I'll reply. And if there's a pattern in what you all are saying, I'll pull it into a follow-up video so we can connect the personal side to the system side. Because this isn't just theory. This is the monthly budget. This is the business invoice. This is the why is it like this conversation people have at dinner tables. Canada's economy isn't broken. It's built. And once you understand what it was built to do, you can finally ask the only question that matters going forward. Is it still serving the people it was meant to serve, or has it quietly started serving itself?